Do you think your ETF tracks the index it's meant to track 100%? The answer may shock you, and let me show you why that is a common misconception. So I think when people get into investing, especially when they're first beginning, they see the word diversification, they think, I want a diversified portfolio, let me buy an ETF to track something, an index, let's say the S&P 500. People hear that the S&P 500 on average returns 8 or 9% per annum. They see that maybe they can get 4%, 3% from a bank and think, let me just track this. I will buy VUSA or VUAG or whatever type of ETF, whatever specific ETF, they'll buy that and then they can immediately get these 8 or 9% returns. The truth is, though, there is a lot more to the equation than what is made obvious or made clear. And this video is to explain that. So I've got Trading 2 and up on screen. People, what they'll do is search S&P 500 and what they'll see, there are loads of different S&P 500 versions. I may do a video separately showing how to pick the right one for you and what this all means. But there are things like whether it's accumulating or distributing, that is about whether you get paid dividends separately or is reinvested, and that's one way that an S&P 500 ETF may not track its intended index. You've got things like the information sector one, the IITU, that tracks only part of the S&P 500. It's different there. The sixth one down here is a 5 times leveraged ETF. Again, leveraged, wouldn't advise that for beginner investors, but that's something that, again, will make it different. It will amplify the movements. And I've also got a video on the liquidity trap as well on the channel, which is relevant to that. We see hedged is the 7th one. That is, again, another type and another reason why, and that's hedging against currency risks. And you also have short and longs, taking short positions, long positions on the market. So there are a lot of different versions of an ETF, and that's one way that this can differ from the underlying index. Though the main point of this video is not to go through that. What it is to go through is why, if you take the most basic bread and butter, ETF, and for example, VUSA, which is the most popular S&P 500 ETF, and that's one from Vanguard. This is one that is a regular long position. It is 1 times leveraged, and it, as you can see on screen here, does not track the index exactly. There is no leverage. It is not an information and technologies one. It is the whole index, and we see here quite significant differences. So this is what you're seeing on screen is over a 6-month time frame. So we're not talking a massive amount of time. What we can see is they both start at 0, and what we are both ending up at is around about 10%. But if we look at the 22nd of January, as an example, the S&P 500, which is the yellow line, which is the index itself, is at about 4% gain, yet the Vanguard VUSA is at 10. And I think the important thing to realise here is that when you're buying into an index, what you're buying is something that tracks the underlying index. You're not buying the index itself. And that is why we can have these differences. The reason why in this case the differences can be small, for example, is due to fees. Fees are charged on practically every ETF, and they vary from being very, very low to very, very high. And it's the ongoing fees, for example, are something that's constantly chipping away at the returns you get on your ETF, and why we would expect the ETF to be lower than the underlying index. So if I go into Trading 2 and 2, pull up VUSA, and if we go down, we can see that we have an expense ratio of 0.07%. Very, very low, and would not be the cause of the swings on that other graph. It's also important to realise here, looking at this, is that the Vanguard, the ETF, is actually outperforming the index in this specific circumstance, which wouldn't really make sense given that we think fees would bring it below the underlying index. And what I'm going to do is show you exactly why this is. So the VUSA is a GBP denominated fund. It is in GBP is what you get paid out in, and people like myself use this as a way to not get charged FX fees on Trading 2 and 2 and other platforms. For example, on Trading 2 and 2, it's 0.15% on all foreign currency transactions, and that is one way to make your investing cheaper, is to invest in GBP or GBX, which is the pence version versions of ETFs instead of, for example, USD. So that is why we see the Vanguard S&P is in GBP. The underlying index is dollars. It's an American index, and that is one difference that we have. This, though, starts to make more sense if you view this with this graph coming up here. And what this is the dollar to pound sterling movement. If you think about it, if you buy an ETF in GBP, what it is doing is taking something that's in dollars and translating it through foreign exchange, and you get the amount that you can buy in GBP of the index, and that is crucial. So if you look at this here, we have a 1 year graph. It's not 6 months, it's a longer period than the other one. But looking at 14th of January here is when we peak on this graph, and that is when the dollar is the most expensive and the pound is the weakest in comparison. When that peaks on that other graph coincides with when this gap is the largest on this 6 month window here. And then what we see when we get towards the end is that contract down. And what that contraction down is what we've seen over the last 3 months, where the dollar has weakened, which is partly due to Trump's tariffs and other things. So what you're doing when you invest through an ETF is you're not only tracking, sort of tracking the underlying index, what you're also investing in really is the foreign currency exchange, and you're saying GBP or USD, for example, one will be stronger than the other. This can work against you or for you. In this case, it had worked for us for a period and then it's not. This is why hedged versions of ETFs exist, and that will be a separate video on this channel. But it is important to realize that whenever you buy something that isn't hedged, this is the issue that you are running into, and it's an additional bit of risk and an additional investment that people make without realizing it. You're not just tracking S&P exactly, you are tracking something that is trying to replicate the S&P or whatever underlying index. With the world as diversified as it is very hard to avoid this phenomenon. If you want to invest in Europe, you can have Euro GBP, you can have USD GBP in the States. It's something that I think investors just have been used to now, but I think the one benefit is over time, if you're investing in major currencies, i.e. Euro, GBP, USD, the movements do tend to flatten out over time. They come up, they come down. We saw it in that USD graph there. And over time, major currencies do not tend to move drastically, though that is not investing advice, and that trend could obviously change going forward. But with that being said, I hope this video has been useful. Please put any comments down below or anything else, and I'll see you next time.